All right, let's take it straight to Robert Sockin, the global economist at Citi, who joins us now to give us his view on all that's been happening across the globe. Robert, thanks a lot for joining in. All eyes will, of course, be on the US Fed rate cuts when they begin. But the focus has really shifted now to emerging markets like India, where, the foreign inflows have started to pick up significantly. As we kickstart the new year, what does your pecking order look like as an economist within emerging markets and in the developed versus emerging market piece?
Yeah, that's a great question. And thanks so much for having me. First, in terms of the just growth outlook, we do think growth is going to slow down globally in 2024. We had a much more resilient 2023 than we were expecting. That was largely due to upside surprises from services sectors. We had underestimated the amount of momentum post-COVID that we'd see in services around the world. But we think in 2024, that process is going to slow, interest rate hikes are going to bite more, and the manufacturing sector is going to remain weak. But that being said, emerging markets are a relative bright spot in our forecast. Most of the slowdown in global growth that we have for this year is concentrated in developed markets. We think a range of developed markets are going to go into recession, including the US later this year. But EMs, while they slow down, are likely to hold up relatively well. Now, in terms of monetary policy, some EMs have already started easing rates. We think more are going to follow throughout the year. And those DM central banks are probably going to start easing around mid-year. We think the Fed's going to start cutting around July, the ECB slightly earlier, and most DM central banks around there. Several EMs will have already started easing before then. But as long as these DM policy rates remain elevated, it's going to be hard for EMs to ease policy very rapidly, given high global policy rates. So we do think EMs are better positioned, but in some sense, their monetary policy is somewhat glued to what developed market central banks do.
Hi, Robert. Good morning and good to see you in. Robert, last evening, the inflation print that came out was a little hotter than expected, though the fine print was pretty okay. Give and take everything, the kind of resilience you're seeing from the US economy, would you want to quantify what kind of rate cuts are you all factoring in?
Yeah, and this is the key question. And I'll say about today's print, something that worries me the most is if you look underneath the hood at services X housing, that has shown very little progress over the last several months and looks to be stuck somewhere at just under a 4% annual pace. And it's why we think in order to really break that type of inflation, you're going to have to see a slowdown in growth and a loosening in the labor market to really bring down wage growth, which is getting passed into those prices. But, that process could happen. It's possible you could still get that services inflation to come down without a recession if the supply side, for example, in the labor market continues to improve. But either way, I think what today's print highlights is the Fed is unlikely to start cutting rates early this year, given that we're still seeing a lot of stickiness in the services side of the inflation equation. So we still have the first rate cut coming in July, and I think this print pushes down the probability that rate hikes start happening sooner. We'll learn a lot more at the January FOMC meeting when we see their tone around how they're thinking about policy throughout the year. But I think this print just shows that even if we do get a soft landing, it's going to be a slowed down move in inflation.
Okay, speaking of inflation, we're just getting those numbers out from China, by the way, and inflation is moderating. We put that on our ticker once again. Inflation at the consumer level, wholesale level, it continues to moderate in China. The export number is a little better than anticipated. Exports in December are up 2.3%, higher than the estimated forecasts out there. But the number for the year as a whole is a sobering decline of 4.6%. Imports are down, even exports are down for China. And that's the last question for this morning, Robert. China, 2023 was completely missing, dealing with its own macro woes. Do you see that changing? Because if China starts showing a recovery in 24, that has huge ramifications for inflation and, all of, these projections on interest rate cuts that we're talking about, right?
Yeah, absolutely. And China, I think, in particular, is getting hit not just from structural issues it's dealing with, like overhang of and restructuring in the property sector, but it's really getting hit hard by this manufacturing weakness that I mentioned and this global trade slowdown. So, that engine of growth that China normally has not been there in this cycle. And so what you've seen is policymakers respond with stimulus to try and boost the economy. We think growth likely came in at about 5.3% in 2023 in China. We're looking for still decent growth in 2024, although a bit of a slowdown to 4.6%. So I would describe that as a modest slowdown, but not terrible. But there's a lot of risks around that forecast, and it's going to require continued policy support from the authorities.
Got it. Robert, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts here. Have a good week.